everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today the first thing that I wanted to get into is just the fact that the S&P 500 did finally yesterday break out to a new high. That new high since February, that was our last time that we had a new high. And, this was completely expected. I've been talking about this for the past couple weeks, that based upon the momentum that we saw in the market had been just very bullish in general, that it was kind of like this runaway train that was going. And so we fully expected, because when the market has a target like that in its eyes, it kind of will do whatever it can to kind of get there and achieve that market, and so that mark. And so we've been trying to hit that all-time high now for a couple of weeks. And again, we kind of bounced off it multiple times last week as well as early on in the week. And then yesterday we did finally break out up just above it. And so, again, short term for the markets, that can be bullish. That does give a little bit of underlying support just because of the fact, like I said, that there has been so much momentum kind of moving us towards that. But what I really did want to get into, though, is, the media makes a really big deal about, all-time highs. And, what does that actually mean for us, especially within the short, the medium, and then the long term? And honestly, it really doesn't necessarily mean all that much. And so first chart that I want to show you is, I have said for weeks now that markets are extremely extended. When we begin to trade too far away from our moving averages, there tends to be a reversion to bring us down closer to that average. And so you can see where we are right now is, so this dotted black line here is going to be our 200 moving day average for the S&P 500. And so we're trading significantly diverged from that 200 moving day average there. And so what this line here just depicts is the fact that if we were to come back down to our 200 moving day average, that would be a decline of just over 9%. And so just trying to show you that a decline of 5 to 10% is absolutely not outside of the realm of possibilities here. It would actually be something that would be very healthy for the market for us to see. Markets have kind of gotten really overextended very quickly without a very good support or base beneath them. And you've known that I've been saying for weeks now, just the disconnect that we see in the market when we look at earnings, the economy, and unemployment, and just this V-shaped recovery that we have priced in with our recovery here really is most likely not actually a very realistic actual outcome that we're going to see. But that's what we've done, what we've seen so far. And so I just really want to caution you here, though, that because now that we've achieved this in the market, that's a great thing. But that does not at all take the risk, especially in these areas that have become so overextended, like the S&P. The NASDAQ would be another example. We're still trading about 3 deviations above our mean there. So again, very extended. In the short term, we should be looking to see some corrections just to bring us back down to a more healthy, normal place. And so again, 5–10%. And the thing though to remember is that when we see a 5 or 10% correction, sometimes they feel a lot worse than they are, and so then we can see some additional market movement as a result of that. But again, just want to kind of put it out there that that's something that can't say it's a definite, and nothing's really a definite in this market right now, but definitely something that we are keeping on the forefront of what is a likely possibility to happen. And then again, just wanted to show you here. So what happens every time the S&P trades too far above its 200 moving day average? So our average is going to be this orange line here, then the S&P performance in blue overlining it. And so this was in February, you can see right here. Then we had our correction back in March. So we're right back to where we were actually in February. And again, we're very extended. But the difference here is that we do have a lot of headwinds against us right now that were not present in the market back in February. When we look at the damage that's been done because of the coronavirus and just the weakening of our economy. And I try not to go over things over and over again that I've already covered. So if this is your first week here, I know we've been having people joining us every week. I would encourage you to kind of go back if you have a second and just watch some of our more recent videos, because we talk about specific areas where we see with the market being disconnected from S&P 500 earnings, the concentration of indexes, which really kind of points to the fact that we are not as healthy as some of these returns might lead us to believe. And so absolutely right now trading above our averages. Averages, remember, they really act kind of like a magnet to pull us down, like a gravitational pull to bring us back. We should be tracking that average closer than what we are right now. And so that's just the point that I wanted to make there. So yes, we did make a new high, very expected based upon the exuberance and the greed levels in the market. So it wasn't at all unexpected. Things that we should be watching out for in the short term, again, would be corrections, specifically in the NASDAQ and the S&P 500. And so I got into this a little bit last week, and so I was able to find a chart to kind of help and show it a little further. One of the concerns that I've had more recently is really how volume of trading in the market has really dropped fairly significantly. And so this bottom here, you can see where trading was back in March. And so we've really leveled off here. We're actually trading with 25% volume less than where we were a couple of months ago. And so the problem when we have less trading volume happening, it's a hollower market. So I say it's almost like the market's losing its oomph. It's losing its steam if we have less volume in it. And so what happens is that it's easier also for cracks to kind of become apparent when we're trading with so much less volume. And so it's actually a pretty significant leveling off that we've seen. And remember, again, we now don't have the additional stimulus coming into the market right now. Most states don't even have the additional unemployment benefits of the extra $300 a week. And so again, this can really trip the market up, I think, on the short term, because that was a lot of additional revenue that was being spent in the economy. Some people were putting it right back in the market, but we were spending it. And so with this drop off, and we call it the income cliff. So we now have this cliff that's kind of looming in front of us. What are we going to do? Right now, it seems like we're at a stalemate when we look at the government's ability to intercede. And again, I fully expected that we would have had a stimulus package. And so for there to not be one, and for there to look like there will likely not be one, at least for weeks, I think, can really cause the whole issue of lower trading volume, that could worsen, certainly at least in the short term. So again, just something to watch, something that makes us concerned. And when we see markets being traded thinly like this, that it's a more hollow market. But in good news, so as we had mentioned before, that yes, we did take equity holdings about a month ago. And so we took them in these very specific areas of consumer cyclicals, specifically targeting areas of online retail, taking areas in a very specific part of technology that really spends a lot with home types technology, work from home, school from home. Again, because these are areas that even with additional economic hardships, that will probably continue to do well. And industrial specifically, it's a industrial construction ETF that we're using, and especially when we look at things like new home starts needing to rise to keep pace with just what we need to continue just with our needs each year. So those are areas that we took, and when we took these positionings, we were using very specific parts of our program, our math and rules-based program, looking at relative strength, positive momentum, because the idea is that over the long term, we want to outperform our major indexes like the S&P. And another note to make is that when we are defensive, as we went extremely defensive when our technicals broke down back in March, we'll always lag the indexes at the beginning. It's just the nature of the way that it works. So when we have to go defensive, we wait for the technicals to turn, that now it is a little safer for us to take positions. And then what happens is, as we do that, as we slowly take those positions, we begin to make up ground and we get to pick up steam. But the idea is that we don't want to do it until we have the confirmation that yes, this is the right place to be. And then once we have that confirmation, then we can really run with it. And we run with it by looking at the areas of greatest relative strength and momentum. And so that is why over the long run, we're able to outperform the indexes. And so I just want to give you an example here. So here is our number one. This would be the Victory Tactical Model right now, up just under 2% since the end of July. S&P 500 index itself is up 4.76%. the Victory Tactical Equity Position, so those 3 ETFs that I talked about right now, they're up 11.77%. And so this is still a very conservative strategy. We only have 15% in the market right now, and so we are looking to probably be deploying in the very near future. Just waiting for a few more of those technicals to turn, especially if we were to see that a 5, 10, 15% correction. We always now have cash on hand to deploy into those best opportunities. But just to show you, so this is how relative strength works. So you find the areas of positive relative strength, you avoid the areas of negative that are going to wind up being drags on performance. And this is how you can outperform your indexes. So again, 11.77 is what those funds have returned against the index of being 4.76. And again, we kind of took a small bite of the apple to start, and we're going to be adding to those positions as well as other areas, over the next few weeks and months. And so again, though, this is the power of using a math and rules-based program. Instead of having to settle for the long run just being whatever the index does, we want to see what that index does and then outperform it over the long run. And that is how we're able to accomplish it. And so, over these next few weeks and months, absolutely, I still think that there is a significant number of headwinds for the market. And so don't misunderstand me. There's been, obviously, the market has had, the indexes have had an incredible recovery. The question, though, that remains is is the foundation underneath of it solid enough to hold it? And that really is where our concern is when we look at these issues of, the election, and there's a lot of uncertainties with how we can have effects on the market from that. We look at increasing China tensions between the U.S. again, that has really caused market uncertainty in the past, and I would expect that would be the case again in the future. So if we look at economy, we look at the detachment of the S&P from earnings, we look at how concentrated indexes are when we talk about performance really being only tied to 5 stocks when most other companies are still even having negative performance. And so we look at all these things, unemployment just in general, the economy, our GDP. And so we say, these are all things that the market's going to have to overcome. We've priced in a perfect V-shaped recovery with no bumps along the road. And so again, we've said all along that our concern was that was not a realistic pricing of the market, and it's why we have been so cautious. And so the reason why we still remain fairly conservative in our portfolios is that we really believe, especially in this immediate short term, that we really are okay with giving up the short-term performance to not risk any additional principal, knowing that we do believe that soon opportunities are going to arise to allow us to deploy this cash into very specific opportune areas. When we do that, we're going to do so happily, and we will happily become more aggressive, because I do well when my clients do well, and so I want my clients to have the best performance that they can. I just also want to be prudent in the way that I do it to make sure that we're not risking principal unnecessarily. And so that's just what I kind of wanted to go over today. Again, if you have questions from week to week as you watch these videos, you can always give me a call, you can email me. Go on our website every month. I do write a blog, and then all of our other videos are archived both on YouTube as well as on our website. And so if you're new and you're not really sure about some of these other things that I mentioned, go ahead, and if you want to go ahead and check them out, you'll kind of see some of the things that many times, what we've been concerned about, we've actually seen, come to fruition, and we've acted upon that. So I thank you so much for joining us today. I hope you're doing well. We look forward to seeing you next week. Take care.